Hello and welcome to our Forex and crypto trading for beginners course. And this episode will show you how to read the trading charts. We'll cover the Japanese candlestick patterns, the market trends, and the support and resistance levels. And the previous videos we showed you how to set up your Forex and crypto accounts and how to set up your trading platforms. If you do not have a Forex or crypto account, make sure to sign up on Binance or Deriv using the links in our description. And make sure to watch the previous videos on how to set up your accounts. I've also left the links in my description. Alright, so if you've come across a Forex trading or crypto trading chart like the one showing in your screen, you have probably noticed that on the chart there are little red and green bars. These are what we call the candlesticks. Alright, so these Japanese trading candlesticks are not just a mere design on your screens. They show how the price is moving in every time interval. For example, in the 1 minute time frame, they will show you the price movement in the last minute. If you look closely at the Japanese candlesticks, you will notice that these candlesticks come in different shapes, and these different shapes have different meanings that you might want to know before you start your trading journey. In brief, let's look at the anatomy of the candlestick. So to your left is a red candlestick. So the red candlestick is a bearish candlestick. A bearish candlestick is one that is formed when the price of a certain commodity on the market in a certain time interval opens high, and then after that time interval, the price closes lower. This shows us the price started high, and at the end of the time interval, the price dropped. To the right is a bullish candlestick. A bullish candlestick is usually painted green. A bullish candlestick is the one that opens at a lower price and closes at a higher price. So it shows how the price moved in a certain time interval. For example, it may show you that in the last minute, the price started low, and when the minute ended, the price was high. So it indicates a price movement from a lower price to a higher price. So it basically implies an upwards price movement. Alright, so there are other factors to note on these candlesticks. So number one is the candlestick body or the upper and lower shadows. The candlestick body will show you the momentum or strength of the upwards or downwards price movement. Alright, so in these two pictures, one on top of the other, these are the different shapes that you might come across in your trading charts. So these different shapes of the candlesticks imply different price movements. For example, these big green or red candlesticks, the full ones that do not have a tail or a wick, or you might want to call it a shadow, they indicate strong movement in their respective directions. Then further to your right, you notice there are candlesticks that look like tiny hammers. Those tiny hammers have different implications or meanings on the trading charts. So if we look at them in detail, there's a pair of green long-tailed candlesticks or hammer-shaped candlesticks. Then to your right is a pair of red long-tailed candlesticks or hammer-shaped candlesticks. So let's look into what each pair means. So let's start with the green pair. So the first green candle to your left shows a price movement which opened low, then the price fluctuated to the very lowest end of the tail up until it also reached the highest end of the tail. So the price fluctuated in the last time interval, but when the time interval ended, the price was now falling, but it didn't cross the starting point. So this candlestick closed higher. So the price for this commodity closed higher than it opened in the last time interval. So what's the market sentiment or the story that this candle tells us? Alright, so this candlestick indicates that there was a very hard fight between the buyers and the sellers trying to move the price up or down. But in the end, the buyers managed to win. But there's a very huge selling pressure from the sellers that pushed the price down until it almost reached the opening price. So the same implies for the other green candlestick to your right. But then this one indicates that the sellers tried to push the price way low, but then the buyers ended up winning. So this indicates very high buying pressure. And the reverse is true for the red pair to your right. However, the red pair can show you higher selling pressure or higher buying pressure. Alright, so why would you wanna understand these candlesticks? These candlesticks normally come or appear when the market is about to change direction. For example, if the price was moving upwards, then the price might reverse and assume a new direction. Now, let's look at a typical example of why we should understand these candlesticks. So, these candlesticks may show you an increase or decrease in the buying or selling momentum. Now, if you look at the picture on your screen, you see that the green candlesticks are decreasing in size as we progress to the right as time moves. So there is a very strong upward buying momentum. Then the momentum starts to slow down in the second candle up until the momentum is now very little in the last candle. This normally shows that the market is about to change its direction. So if the price was moving up in the last minute, then it's about to change direction and start moving downwards. Let's look at this example. In the blue rectangle that I have highlighted, you see that there is decreasing bullish momentum shown by the 3 candlesticks. And after the 3 candlesticks, the market changed its direction. So along with other techniques, these candlestick patterns will help you predict where the market will go next. Now, let's look at another example. In this example, you will see there are 3 huge red candlesticks. The candlesticks decrease in size as we progress to the right. The first one shows very high bearish momentum, and then the next one shows a decrease in that momentum. Then the last one that is reaching this blue rectangle is now a very small bearish candlestick. What happened next is there is a change in the market direction. And then if we analyze the second rectangle, the second blue rectangle in the middle, you see that the very same pattern in the last one that we analyzed is repeating itself again, and it has the same implication. The decreasing momentum of the candles will show you the market is about to change direction. If we analyze again to the far right, we'll come to a conclusion that the market is about to reverse its direction and go up. Alright, another example is this hangman candlestick forming in an uptrend. So at this resistance level, when this hangman forms in an uptrend, it usually indicates a potential reversal in the market direction. So the price may reverse and tend to go down. On your trading charts, various candlestick patterns may form, and you might want to know the basic candlestick patterns that are there. So I'll give you a trading cheat sheet. So in the cheat sheet, you see there are candlestick patterns, and these candlestick patterns can either be bullish or bearish. What do we mean by bullish candlestick patterns? Bullish candlesticks are candlesticks that indicate a potential upward movement of the market price, and the bearish candlesticks indicate a potential down movement of the price. So like I said, these candlestick patterns may form near support and resistance levels. And I'll explain in a bit what support and resistance levels are. But when you see these candlesticks forming in such areas, they may indicate a potential change of the market direction. If the market was going down, then if you spot a bullish candlestick pattern, then the pattern may signify that the market may change in the upwards direction, and the reverse is true for the bearish candlestick patterns. Alright, so if you are writing down some notes on these candlestick patterns, make sure to check the link in my description because I have left a link for you to download this trading cheat sheet. The cheat sheet has all the candlestick patterns and the chart patterns that you wanna know to master how you can read the trading charts. Alright, so in your charts, these candlesticks will form one after the other and they will form what we call chart patterns. And these chart patterns will form what we call market trends. For example, in the chart that you are looking at, there is a price movement that is zigzagging, but then it's going downwards. If you look closely to your left, there is an inscription that is labeled LH. LH simply stands for lower high. Then there's another inscription which says LL. LL implies a lower low. So these candlesticks are forming lower highs and lower lows. So simply what a high or a low is, if you look closely at this chart, you see that a high is a peak or the highest point the price reached, and a low is the lowest price the price reached before it changed direction. So if you are looking closely, you can see that there is a trend in this chart. So if we analyze from the far left, you see that the price was going upwards. Then it reached a peak and started going downwards continuously up to a point where it stopped. It moved sideways, then started going upwards again. So these price oscillations in a certain direction, for example, this price oscillation in the downwards direction is called a trend. A price oscillation in the downward direction, it's a downtrend. If it's a price oscillation in the upwards direction, it's an uptrend. If it's a horizontal price oscillation, it's called a sideways trend. Now that you have seen firsthand how these trends are formed, these definitions will help you understand what an uptrend is, a downtrend is, or a sideways trend is. You might want to take a screenshot so that you keep these terms in your mind, because we are going to use these terms a lot in our trading sessions. Now, put simply, as you can see in this bearish trend, a bearish trend is just a downtrend. Why we call it a bearish trend is when a bear attacks, it attacks from the upright position and pounces on a prey downwards. So a bear dives down on a prey. And the reverse is always true for a bull, because when a bull attacks, it will attack from the ground and lift you up with its horns. So this bearish trend is a price pattern that oscillates downwards. So if you notice, you see that the peaks in this pattern are consecutively forming lower than the last peak. So these highs are getting lower, lower, and lower. So we call them lower highs. Alright, so this bearish trend is characterized by lower highs and lower lows. Now let's look at the Doe's theory of the trend definition. Mr. Doe was the father of technical analysis. He is thought to be the first one to use price action. So a trend is the one which forms higher highs consecutively, each after the other. It forms higher lows one after the other. But if you analyze further to your right, you realize that when the market starts forming lower highs and lower lows, the market direction is reversed. So that's the end of the uptrend, and a potential downtrend is now forming. Alright, so another fundamental concept is the concept of the support and resistance. Alright, so put simply, a resistance is just a level or a zone which the price fails to cross. So the price moves upwards, then when it reaches that zone, it never crosses. The market direction will reverse and then try to go up again, and it will fail to cross. So that forms a resistance. So we say the buyers are resisting to buy at such a high price, or they are refusing to buy at a price beyond that one. This is common in any market. There is a price that we can tolerate for a certain commodity, but beyond that price, it becomes very unreasonable to buy. And then the price may fluctuate within a tolerable range. This range is the range between the resistance and the support. So here, as you can see, the support is the lowest zone or range the price reaches before it changes direction upwards again. So the price will move back to this zone multiple times and fail to cross. So that zone is called the support. Alright, so in this snapshot is how you can find support and resistance levels on your chart. Put simply, these levels are just the levels the price fails to cross repeatedly. It can be 2 or 3 times. That's enough to form a strong support or resistance. Alright, so here is how it looks like in a real chart. So as you can see, in the upper line we have a resistance level. So the price bounces off the resistance level 2 times. So if we draw a line across, we can see that whenever the price tries to reach that line, it will have to respect that line and bounce back. So that helps us understand or try to predict the next price movement. And then in the bottom is a support level. That red line with 3 circles on it is the support level. As you can see, the price reached that support level and bounced back upwards. It went upwards for some time, reversed and came back for the second time, then bounced off, went up back again, and for the third time bounced off. So that forms a support level. And these support levels will help you understand where the market direction is most likely to reverse or change directions and help you predict the next price direction. So from everything you have learned so far, now where can reversals happen? You see that the reversals that we have looked at were often happening on support levels or the resistance levels. You don't have to worry about the Fibonacci levels because we will cover those in the next episodes. Alright, so in this image is an example of the support and resistance zones or levels in a sideways market. You will see that the areas where the price or the market is reversing directions are in these support or resistance zones. Next, if we try to analyze a downtrend the same way, you realize it's a little bit tricky. Why? Because if you notice, when we draw these white lines, the price crosses those lines, and then if we draw the other line, the price will cross again, and again. So you realize that these support levels that we're drawing in white lines, when they are crossed, they become a new resistance level. So when the price crossed it, it tried to go up again, and when it reached that line, it had to move back in the downwards direction. It crosses the second line again, and that second line forms a strong resistance. And when we try to draw the third support line, when the price crosses that line, it becomes a strong resistance. So this is what we call a breakout. When the previous support is broken, it becomes a strong resistance. When the previous resistance is broken, it becomes a strong support. So in this downtrend, it's trickier to use horizontal support levels. So instead, you might want to use a trend line which looks like the red arrow. So if you look closely, you realize that this red arrow, if we bring it close to the peaks, you realize that the lower highs will almost all connect on that line. Alright, so as shown in this next image, you see that the support and resistance are descending lines or trend lines which are painted in red. So these two descending red lines form what we call a descending channel. So the price is moving in between this channel. So when the price moves to the red resistance line, it has to change directions and go down. And when it reaches the support, it has to reverse directions again and try to go upwards. But you will notice that this price movement will remain within this descending channel, and when it breaks this descending channel, it means there is a possible trend reversal. So if we were in a downtrend, then we might be noticing possible indicators of a possible trend reversal into an uptrend. The same is true if you look at this arrow. You see that if you try to draw trend lines on this chart, your support and resistance will almost form an ascending channel. So that's what we call support and resistance levels. This concept helps us forecast the possible market direction in the next time interval. So if you look at this image, where do you think the price will go next? Yes, I think you guessed it right. The price is most probably going to move in the upwards direction because we have hit the support level, so we anticipate the price to move back upwards. Alright, so that's how you read the trading charts. And the next episode, we're going to show you how to analyze the trading markets. We'll cover technical analysis systems like the price action.